Good morning. It's Monday, the 16th of December, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming from Mumbai, India's financial capital. We are in the final 2 weeks of 2024, and I do hope you've had a great year as a manager, business person, entrepreneur, investor, or just a listener of the core report. And the take. So far, we've heard of Donald Trump's wide-ranging threats to impose tariffs on imports into the United States, and special about varying tariffs on countries like China, Mexico, and Canada. And then 100% tariffs on the BRICS countries like Brazil, Russia, India, China, and South Africa, or among others, dreaming of, or lack of any other term for the present, the fact that they could form a BRICS currency to take on the dollar. Now, countries like India have chosen to stay largely quiet and been even on the defensive, and chosen also to wait and watch, which is perhaps the wisest strategy to follow at this point. Others like Mexico and Canada have already reached out to Trump in person or on telephone, and quite likely even won some temporary peace, though there is no way of saying that right now. But the fight back is beginning from businesses and affected industries, even as countries like Canada have revealed their strategies. The US agriculture industry, to speak about what's happening within, has started talks with Donald Trump's transition team in an effort to advocate for the food business as the president-elect pledged tariffs and mass deportations, says Bloomberg. It is also becoming clear that tariffs will not be easy to impose, particularly as resistance starts building from the point where the rubber meets the road, so to speak. So groups like the National Grain and Feed Association, which represents agriculture companies like Archer Daniels Midland and Cargill, and the International Fresh Produce Association were amongst those involved in the discussion, says Bloomberg, adding that the National Council for Agricultural Employers also has a meeting on the books. Attention is also being drawn to immigration issues as the US agriculture has been increasingly reliant on foreign labor, and some industry advocates are lobbying for the expansion of a visa program for temporary workers, according to Bloomberg again. On the other hand, Canada is now apparently examining the use of export taxes on major commodities it exports to the United States, including uranium, oil, and potash. Export levies would be a last resort for Canada, according to officials familiar with those discussions that Bloomberg spoke to. But retaliatory tariffs against US-made goods and export controls on some Canadian products would be more likely to come first. And here is the interesting part and an insight into the interconnectedness of economies. Bloomberg says Canada is by far the largest external supplier of oil to the United States, and refineries depend on buying cheaper Canadian heavy crude and have few alternatives to it. So the US Midwest would be particularly hit and hard by higher costs because fuel makers in that region rely on Canada for almost half the crude they turn into gasoline and diesel. So refineries that are in the Midwest, that's the northern part of the United States, rely more on Canadian crude imports. Moreover, Canadian uranium is also the biggest foreign source of fuel for US nuclear power plants, and potash from the country's western provinces is a huge source of fertilizer for American farms. It's quite likely that many of us didn't know all of this. And here's the twist in the tale. The US Department of Defense has actually been investing in Canadian projects to secure sources of cobalt and graphite and to reduce reliance on Chinese supply chains. So now, the belief is that the Trump administration will exempt commodities from his threat to place a 25% levies on goods from Mexico and Canada and focus instead on using tariffs against their manufacturing industries. Now, all of this obviously tells us that imposing blanket tariffs, as promised a few weeks ago, will not be simple, and one can expect much resistance along the way, including from quarters least expected. For example, America's National Retail Federation last month pointed out that American consumers could lose between $46 to $78 billion of spending power each year if new tariffs on imports to the US are implemented, for example, in apparel, toys, furniture, household appliances, footwear, and travel goods. Obviously, these retailers feel that they cannot pass on all price increases to consumers when will also lose margins. And the US already has seen very high retail inflation in the last few years. Now back to India. The government is considering a proposal to impose safeguard duty on steel imports, according to the Steel Minister H.D. Kumaraswamy on Thursday. He told a news agency last week that the process was going, and the process being the proposal to impose a 25% duty on steel imports. Now, on December 2nd, that's 2 weeks ago, the Steel Ministry, in a meeting with the Commerce Department, had proposed a 25% safeguard duty on some steel products imported in the country. So a decision might be halfway, a lower figure on some types of steel, but it's clear that Indian industry would have succeeded in its efforts to sway the government, though maybe it's taken longer. There is no doubt that steel coming from China and Vietnam is coming in at very low prices or cost price thanks to overproduction there, wherein steel mills are running just to make sure that they're able to meet their costs. But it's also a fact that lower prices would benefit users of steel, for example, the construction and infrastructure industry. And as you know, a lot of Indian investment, that's public investment, is going into infrastructure. Business leaders have often told me privately that Indian industry would always prefer a higher tariff regime, and the rising import duties in recent years reflects that, combined, of course, with the government's own Make in India program. But the flip side of that argument is also important. While India can slap higher import duties on toys and the like and succeed to a large extent, it cannot do the same in mobile phones or mobile phone components if it wants to provide cheap telephony to hundreds of millions of citizens and also encourage a domestic manufacturing industry, including for exports of the likes of Apple. So, Donald Trump or his advisors quite likely know all of this and how some of the pulls and pushes work in the area of trade and global trade. But the threat of tariffs has obviously got the world on a forced game of musical chairs, not knowing whether there are enough chairs or if and when the music will stop. And that brings us to the top stories and themes for the day. A lucky Friday the 13th changes market sentiment. India's rice inventories have hit 5 times the government's target. What happens if India increases taxes on the rich? India's refurbished phone market is growing. And lessons for India's insurance industry from a US shooting incident.
This is the Core Report with Govindraj Ethiraj.
And a lucky Friday the 13th. We do use the word roller coaster often, but Friday trade last week was closest to what a real roller coaster ride was, with the markets crashing and then recovering sharply all through. The markets posted their 4th weekly gain, which is also the longest such streak since end July, according to Reuters. Meanwhile, the 30-share Sensex closed at 82,133, up 843 points, up from its previous close on Friday. And check out the range. It traded between 82,192 and 80,082. So almost 2,000 points. The Nifty 50 was up 219 points to 24,768, and it swung between 24,180 and 24,792. The broader markets represented by the Nifty Mid-Cap 100 and the Nifty Small-Cap 100, however, were lower but very marginally on Friday again. The overall weekly gains for the Nifty and Sensex were there, however, only slight, close to about 0.5%. So the interesting thing before we go from this segment is that the indices are now trading only about 5.5% below their all-time high levels hit on September 27th after slipping into correction territory in early November. According to Reuters, remember the correction that we saw and was expected and projected to some extent was 10%. Rice inventories jump. The country's rice inventories have jumped to a record high at the start of December, more than 5 times the government's target, according to Reuters. Such inventory levels could also boost overseas shipments, and India is already the world's largest exporter of rice. Rice reserves, including unmilled paddy, says Reuters, in state granaries totaled about 44 million tons on December 1st against the target of 7.6 million tons. This is sourced from data from the Food Corporation of India. Meanwhile, wheat stocks on December 1st stood at about 22 million tons against a targeted 13.8 or about 14 million tons. So both wheat and rice are at surplus levels. Last year, India had restricted exports of all grades of rice, but the anticipation of a bumper crop, which we are seeing thanks to above average rains, led to the government removing export curbs on all rice grades except for broken rice. Meanwhile, Indian wheat prices, says Reuters, have jumped to a record high due to strong demand, limited supplies, and a delayed release of stocks from its government warehouses to augment supplies. Used phone sales are climbing. We usually speak of smartphone sales as a gauge to understand the consumer economy. However, India, like cars and two-wheelers, also has a strong market for the refurbished phones served by companies who've set up the pipelines to collect your used phones, spruce or repair them, and then put them back in the market. Gurgaon-based Cashify, which deals in refurbished phones, put out a survey recently which said that sales of 5G models rose from 13% in the first half of 23 to about 17% in the first half of 2024. And through the year, refurbished phone sales also increased over 100% from Jan 2024 to the first half of 2024. Now, all of this highlights a growing awareness and acceptance of refurbished mobile phones among consumers. Remember, there's also finance available. Of course, some things are similar to the primary phone market, like 2 in every 5 Android users wants to switch to an iPhone. I belong to the other 3, incidentally. And by the way, some 3 in 10 iPhone users want to switch back to Android, according to this survey. 1 in 2 customers dreams of owning an iPhone but faces budget constraints. But here's the interesting thing. Some 63% of Cashify survey respondents have a used phone sitting unused at home. Moreover, 60% of people have at least one phone at home that needs repair, but they choose to buy a new one due to the high repair cost. So that's a whole lot of phones sitting around. And finally, 1 in 4 prioritize a good camera, which is not surprising at all. I spoke with Mandeep Manocha, co-founder of Cashify, and I began by asking him about some of the trends that he was seeing in the refurbished phones market.
See, I think we've seen a very interesting premiumization trend over the last couple of years. And I think I can, when I speak to my counterparts in the new smartphone sale industry, Apple has moved from, say, less than 2% market share to now about 5% market share. We are seeing the same trend in refurbished. And essentially our business is of, catering to the aspirational need of people. People who buy a refurbished or used smartphone, someone who does not have the money to buy a new product, but they are very, very aspirational. And that's what we are seeing as a trend trickling down at all the stores that we run. And it's very interesting that a youngster in the age of 18 to 25 or 26, people in college, first time in jobs, they all want either the latest or say, if latest iPhone is 16, they're happy to have a 12 or a 13 because it improves their social capital in front of their friends. So I'm seeing that trend. And, there have been interesting cases of first time job people with salary of 30,000 rupees, but with an aspiration to buy a 30,000 rupee phone. And we are able to, fulfill this need by some aspect of affordability, which comes in with, say, a 6-month or a 9-month financing. But overall, I'm seeing a lot of premiumization as a trend setting in this industry. And it's not just iPhones. We are seeing that, demand is also getting generated in high-end Samsung Galaxy phones, OnePlus devices, etc.
That's a demand side to which I'll come back. Tell us about the supply side. I mean, if people are able to get their hands on an iPhone 12, that means someone is selling them. What's the frequency there like? I mean, and I'm sure there the behavior is quite different.
Yeah, so, I've seen the behavior change quite a bit. If you remember the times when Nokia was the leader, people used to hang on to their phone for 4 or 5 years because the phone was such that you didn't need to change it. But we saw the refresh cycle come to 12 months to 15 months. Today, the refresh cycle has actually gone up to about 18 to 24 months. Because the phones are getting more and more sturdy, the quality is good, and they're getting more expensive, people are hanging on to them to slightly larger time frame. But another interesting fact there is that, not all the phones come back into the circular economy. Our estimate says that about 80% of the phones actually go in people's drawers and cupboards. Only 20% people actually end up changing their phone. It could be either when you're buying a new phone, you hand over your old product, or, you're pulling out the old phone from your drawer, selling it, getting cash. But 80% of it's still lying in people's drawers. And I think that's where, companies like ours, we are putting in a lot of efforts and energy into educating the people. That's valuable resource which is lying there. It's one, it's money. Second, it's resource of this planet. I mean, ultimately, if that does not come back into the mainstream economy, either through extending the life and making it available to somebody else or recycling it, that valuable resource is lying in your house.
And tell us about how you do and manage the throughput and the logistics of this. So let's say a phone that you have to pick up from Bangalore versus Noida versus Calcutta or something.
See, as a customer, you could be anywhere. You come onto our app, we give you a price. If you like the price, we will come to your doorstep. Now, in about 100 cities, we have our own feet on street. I mean, we have our riders who are trained in evaluating a phone at the doorstep. So they will run a diagnostic tool on your phone, make sure that whatever you have, told while getting the price is correct. They'll do a physical inspection. We're also deploying, a box wherein you just put the phone inside the box and it'll do 360-degree imaging of the phone and tell you where are the scratches, dents, etc. So everything is very, very objective. Once that happens, and you as a customer, you're okay with the price, we pick it up. We bring all the phones to our central facility in Noida. This is a facility spread over 80,000 square feet where we test every phone, we grade them, and then we refurbish them, and then it's sold back to an end consumer either through our online platform or about 180 stores that we operate.
Is that seasonal or is that a continuous cycle of sales? How does that
Yes, there is some bit of seasonality in this. Typically this quarter, just after Diwali, is where our procurement cycle peaks because people buy a new product at this point in time in the year. That's where our procurement cycle increases. But this is the only cyclicity that we see in terms of more and more phones coming in. The other cyclicity we see that whenever a new phone is launched over a period of 5 days before and after, we see a peak. But otherwise, we do about 150,000 phones a month is what we procure and we sell. That's a kind of, over the last 2 years we've seen about 20-30% growth year on year. But that's something. Now we are at a stable state, and I think this business is growing pretty solidly from where we are today.
And you're saying that including the cost of picking up that phone, putting in that box, running it, training those people, bringing it back, delivering it out again, either through your own platform or through your store, that 180 stores that you talked about, this is still a profitable business.
Yes, there's still a profitable business. I can give you a macro view on this. If I buy a phone from Mr. A and sell to Mr. B directly, there is about 25 to 30% margin available. This is the gross margin that I'm talking about. Now, our business has multiple, verticals. We sell to distributors as well. We sell to, people who retail. So the margin is redistributed amongst each other, but ultimately it's 25 to 30% which is available. So even after doing all the, hard work of picking it up, repairing it, putting a warranty, it's still a profitable business. I mean, as a company, we are profitable now.
At this point of time, which is where we are, let's say end of 2024, some parts of the economy are slowing down. There is clearly some demand compression that we can see in the economy as a whole. Does that benefit you in some ways like it does in some other industries and sectors?
I will answer it slightly differently. I'm seeing that, smartphone sales are flattening out. So if 150 million new smartphones were sold last year, this year the trend remains the same.
157 or so, yeah, roughly.
But the interesting fact is that the feature phone user is not moving to smartphone. But inside the smartphone segment, somebody who was using a 10,000 rupee phone is now wanting to buy a 20,000 rupee phone, so on and so forth. So what I touched upon initially is where the aspirational nature of people has kicked in. So people are wanting to buy, more and more premium phones. So that affects our business in a positive way.
Okay. And why are people not switching from, in your understanding, from feature phone to smartphone?
I think that's a lot to do from the macroeconomic perspective that a certain section of society is not getting richer. It's only, one section of society which is gaining. But I think the bottom of pyramid, the GDP per capita is not improving as much. And that's my understanding. And that's why people are not moving from the feature phone to smartphone, because there is a price hurdle. Somebody who's using a 2,000 rupee, 3,000 rupee phone suddenly has to take a leap to about 10 to 12,000 rupees. Because between that 3,000 to 12,000, there is no good option available anymore.
Right. And what would you tell someone who you want to convince to, let's say, buy a used phone? I mean, if you want to make a case that, to people who are listening, saying that, okay, instead of whatever, using up more lithium or plastic or metal.
No, I think it's a sustainable choice. And more so, it will, help you. Your outflow of money would be lower. A good quality refurbished phones are available with at least 6-month or 12-month warranty. They are properly checked, tested, and they are cheaper by at least 30%. So you can do good for the environment as well as save money. So I think it's a great proposition for you.
Right. Mandeep, thank you so much for joining me.
Thank you so much.
Should India increase taxes for the rich? India should do more to tax its super rich given its high levels of inequality, French economist and author Thomas Piketty said on Friday. In 22-23, he said the richest 1% of India's population controlled about 22% of the national income and held 40% of the nation's total wealth. So, richest 1% hold 40% of India's wealth. Piketty is the author of bestseller Capital in the 21st Century, and he also said that India should be active in taxing the rich. And he said this in Delhi last week in a report in Reuters. He also said that India could raise annual revenue worth about 2.7% of GDP or gross domestic product by imposing a 2% wealth tax on people with assets of more than about 10 crore rupees. And he also talked about a 33% inheritance tax on property worth at least the same amount. Also, the proportion of national income held by the top 1% richest Indians has now surpassed its counterparts in the United States and Brazil, Piketty said, citing a 2024 report that he co-authored, published by the World Inequality Lab. The problem with all of this is this. As India's chief economic advisor, V. Ananta Nageswaran said at the same event in New Delhi last week, higher taxes could lead to higher outflows. Now, this is, of course, something that we've seen. Now, here's some background. The government has already abolished a mostly and rather already redundant wealth tax in 2015 and has also ignored calls for its return or the introduction of an inheritance tax. Over the past year, the cumulative wealth of India's 100 billionaires increased more than $300 billion to $1.1 trillion, thanks, of course, to the stock market booms, according to the Forbes list of the richest Indians, which was published this month and is quoted by Reuters again. Now, some 4,300 millionaires were expected to move out of India in 2024, according to investment migration consultancy Henley & Partners, which is the third highest after China at 15,000 and the UK at about 9,500. Last year's figure was higher at 5,100 for India, though, but the number has slowed down, at least for now. But the fact is, and there is no doubt, that Indians who can are getting overseas domiciles, including in Dubai. Now, tax is the key reason for these moves, though it's not the only one, and can also include education for children and a larger pursuit of quality of life. Finding the optimum level of tax which keeps businesses in India content versus the desired level of revenue, that's tax revenue, is of course never an easy task. The focus, therefore, really needs to be on fixing inequality by raising the incomes and lot of those on the other side of the inequality spectrum. That is, of course, easier said. Lessons from a shooting. The recent shooting and killing of an insurance industry CEO in the United States has sent shockwaves around the world, equally for the sympathy the shooter has received, particularly on social media. The common and underlying grouse is, of course, that insurance companies have treated their claimants badly over time, including, of course, in the United States. Interestingly, the shooter did not or does not appear to have encountered or suffered at the hands of an insurance company, at least going by reports. But the case does, of course, highlight the importance of consumer friendliness or the lack of it by insurance companies anywhere, since they all collect premiums, including for hospitalization and the like, and they act tight-fisted or dodge claims when the time comes to pay up. I used this opportunity to reach out to well-known consumer affairs lawyer Jehangir Gai, and I asked him how Indian insurance companies were handling their claims and what we could take away from this unfortunate incident in general.
Okay, I can most emphatically say that insurance companies are not treating their customers fairly. In fact, about 80% of the complaints in the consumer courts are against insurance companies. And it seems that the insurance companies have a wait and watch policy. Even after a law point is very well settled, insurance companies refuse deliberately and intentionally to follow the interpretation of law laid down by the courts. They keep repudiating the claims. And what happens is, let's say out of 1,000 claims which are wrongly rejected, maybe about 200 will send a notice, about 50 will file a case and fight for a right. Those 50 who fight for a right, after years of tenacious battling, get the money. Remaining 950 out of 1,000, though they are wrongly rejected, the insurance companies get away with that. So that is why, since there is no deterrent action, they keep on indulging in the same so-called mistakes in dealing with claims. The second aspect is that even when compensation is awarded, it is quite a pathetic amount, maybe 6%, 8%. And who pays that amount? It is not the official who has wrongly repudiated the claim. It is the insurance company which ultimately pays the compensation out of public funds. So that is why the officials don't change their attitude and continue in the same unfair manner.
Okay, I'm going to come to some specifics, but when you talk about claims sitting in courts, and you said that 80% of complaints in the consumer courts today, I'm assuming you're referring to Mumbai, are against insurance companies. Are they any specific types? I mean, are they to do with hospitalization or other forms of general insurance or life?
Basically, Mediclaim is the worst sector. The other sectors, there are complaints, but not as many. Percentage-wise, almost every health claim, somewhere or the other, the insurance company cuts the amount, reduces the amount, delays payment, avoids payment. They come up with various excuses to repudiate claims. Because ultimately, the consumer is up against a wall because healthcare costs in India are very high. He ends up paying lakhs of rupees for medical services, and the insurance company does not bother to pay heed. The favorite two clauses of the insurance company, one is diabetes and hypertension, and the other is reasonability clause. Now, what the insurance considers reasonable is something very, very unfair, their interpretation. Because the insurance company says that if X doctor charges so much, of course, it's unsubstantiated, but if X doctor charges so much, we will not pay anything higher than that amount. Now, the type of service which a medical practitioner gives, it depends on the seniority, the infrastructure in the hospital, the complexity of the surgery. Various things are involved. You cannot have one rule that, okay, X will be the amount. It's not a packaged commodity that you simply fix the amount and say we'll pay so much and nothing higher.
Right. So you talked about diabetes and hypertension. So are you saying that the insurance companies treat them as pre-existing conditions that have not been revealed at the time of getting that insurance policy?
Sometimes they are not revealed. They are often treated as minor ailments. Sometimes even after disclosure, the insurance company simply underwrites the policy and then comes up with the objection at the time of settlement of the claim. Many times the disease does not have anything to do with hypertension. Even then the claim is repudiated. Let's say a person meets with an accident. Hypertension has nothing to do with it. It's simply a hit and run case. The person is hospitalized. But when the medical history shows that he is a hypertensive person or a diabetic, the insurance company repudiates the claim.
And you've seen specific cases like this? Case where a hit and run accident victim is denied his or her claim because of a pre-existing condition of hypertension.
Yes, there are various other cases also where the insurance company says no correlation. The treating doctor, the operating surgeon stipulates that there is no correlation. And yet the insurance company denies the claim. Not only that, many of the panel doctors of the insurance companies are not qualified. Now, let's say a person undergoes a cardiac surgery. Who else can opine on that surgery than a cardiologist? An Ayurvedic or an Unani doctor definitely cannot comment. An MBBS doctor may have some general experience, but this is a specialized field. So you cannot get any doctor to give an opinion against a professional who is an expert in that particular field.
Right. So let me ask you the question from the other side. Where is it that, let's say, those of us who apply or go for policies, that's hospitalization or healthcare policies, make a mistake? So one is to say that the insurance company is acting truant, and that could be true. But equally, are maybe consumers not sufficiently aware or not taking the right precautions when it comes to actually applying for these policies?
According to me, the most important factor is that the proposals and the policies are printed in such fine print that it's difficult for an average consumer to read them. In fact, there was one judge in the court who commented, he quipped, that I can't read the terms sitting on the bench, the papers produced before me, I can't read them. So how do you expect a consumer to go through them with a fine comb? So it's not possible. Secondly, normally because of paucity of time or lack of knowledge, it is the agent who takes the information from you and fills up the form. So it goes tick, 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 all the things which the insurance company, which favor the insurance company, or nothing which are detrimental to the insured, they are not checked. So what happens is that the policy is issued. The agent is happy because he gets his commission only when the policy is issued. And finally, when there is a claim, it is the consumer who suffers.
Right. So, two things maybe that consumers need to be more careful and aware of. And you've already talked about diabetes and hypertension, but how does one bring that into to the fore at the application process? And on the other side, two things that companies can do to be more friendly with the people who pay them their premiums.
Let me put it this way. There are several cases which I've come across where the moment the consumer case is filed, the insurance company does not even bother to contest the case. Immediately on the first date, without filing their reply, they say, come on, let's settle the matter. I'm not against settlement, but if you knew that you have no case, why did you force the consumer to knock on the doors of the consumer court? So you're well aware, you have to be consumer friendly. And you have to ensure, and we have to admit it, that most people cannot read minute fine print. So it has to be properly explained. It has to be witnessed. Many times there's no witness. Something is explained. Forms are sometimes left blank. Even when the information is not filled in, the insurance company treats this as suppression of facts. Now, if you are not satisfied, if the information has not been filled in, you can refuse. You can say, please fill in the information. You accept the incomplete form and then you raise an objection at the time of settlement of the claim. That's not fair, I think.
Anything that you would say which insurance companies need to do so as to ensure that they don't unfairly deprive people of their rightful claims?
I'll simply put it this way. When there is a law laid down, a precedent by a court, a consumer court or any court, don't ignore the precedent. When you know that the law is interpreted in a particular way, why still avoid settling the claim according to the law laid down? So that means you are giving rise to multiplicity of litigation because each consumer who has identical facts has to still fight for his rights.
Got it. Jehangir, thank you so much for joining me.
Thank you very much.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.